This is the last video in this wealth management tutorial. In this one, we're going to cover a couple of very quick topics: rebalancing the portfolio, and then I want to show you an Excel spreadsheet for manager attribution. So rebalancing the portfolio, the key issue here is, are you going to outsource the rebalancing or are you going to do it yourself? If you followed my previous videos where I talked about using target dated funds like from a Vanguard or BlackRock, where you have an all-in-one solution, you go to them and put all of your money into one fund. It could be in multiple places, so you might have a taxable account and a tax-exempt account, and you might put 100% of both of those into a target fund that meets the date that you want to retire. If you do that, you've essentially outsourced all the rebalancing, and whoever is running that target date fund, they will do all the rebalancing for you. If you are going to do it yourself, you are going to manage your portfolio, you're going to buy some large cap stocks, some small cap stocks, international stocks, your own bonds. Over time, you have to be careful, because if the stock market's up dramatically, then your stock allocation might be over allocated. You might want to have 60% in stocks, but you might end up at 64% in stocks because the stock market has been very, very strong. So the question is, when do you rebalance? If the stock market's up, let's say you bought some emerging market stocks. And emerging market stocks can be very volatile. So maybe they were up 70, 80%. And you wanted to have 10% in emerging market stocks, but now you have 14% because they've done so well. When should you sell emerging market stocks to get it back to 10% and reallocate that extra amount to the other assets? There have been many studies on this question. The issue is balancing between two forces that are very strong forces. One is reversion to the mean. We spoke about that in a previous video. The second is momentum. Reversion to the mean, what that is when something goes up a bunch, it's more likely to perform below average going forward. If something has been down a bunch, it's more likely to perform better than average going forward. That's reversion to the mean. So if you expect stocks to make 8%, but for 2 or 3 years they made 15, 16%, then they're more likely to make only 5 or 6% going forward. And there's also a good chance of a correction. If a stock or an asset class has really zoomed up in the previous year or two, there's a good chance they could sell off dramatically. We saw that in 2000 with the dot-com stocks, where they were up dramatically for 2 or 3 years, and then in 2000 they dropped 70, 80%. So that's reversion to the mean. What you want to do there is those assets that have been really running, you're worried they may be overvalued, they may be due for corrections, so you want to rebalance back to your original allocation and cut some of that extra allocation that was driven by the strong performance of the asset class. However, that goes in the exact opposite direction of another phenomenon in finance, which is momentum. What momentum says is stocks or asset classes that have recently been doing really well will probably continue to do well. Assets or asset classes that have recently done poorly will probably continue to do poorly. Momentum has been well documented. It does exist. It can be measured, and it's somewhat reliable. So if you rebalance too frequently, like every single day, you're essentially throwing away all of that momentum. So you need something that's going to allow an asset class or an asset that's running up to let it run its natural limit. Let it keep going up, because that's the momentum that we see in markets. However, at some point, the momentum is going to lose steam, and when it corrects, it could correct dramatically. So that's the reversion to the mean. How do you balance between these two? The studies I've seen have traditionally come out that once a quarter is a good period of time to rebalance, but some people think it's longer than that, some think it's shorter than that. But quarterly is not a bad point to go to. So once a quarter, you look at where your assets are and you move them back to your original target. So if emerging market stocks are at 14%, once a quarter you'll look at that and you'll move them back to 10% and reallocate the rest of it to the other asset classes. The second issue I want to address, and this is the final issue, is manager attribution. What manager attribution means is how has your portfolio manager performed? Have they done a good job or have they done a bad job? If they've done a good job, where are you seeing it? Where do the numbers come out? We cannot do a full-fledged manager attribution in the Excel spreadsheet I have because we need access to a lot of data we don't have. A true manager attribution will ask the question, why did my manager do so much better than the index or so much worse? So if you hire a manager and they're up 15% and the stock market's only up 10%, you might ask, where did that extra 5% return come from? Was it from them picking really good stocks? Or was it because they overallocated tech stocks in general and tech stocks did really, really well? Or if it's an international manager, which countries did they pick or which currencies did they pick? So manager attribution can get into quite a bit of detail, but I'm going to show you a spreadsheet that does answer the basic questions of manager attribution. So this spreadsheet is in a larger file that I gave you earlier. We saw this when we did the Efficient Frontier. This sheet is part of that file. I'm pulling in a mutual fund called the Fidelity Contra Fund. It's a very large and very popular mutual fund. It has performed well over time. I brought in some prices. So this is essentially the price of the fund. And so as the price moves, it gives you a return. So the price back in 87 to 88 went from $1.07 to $1.14. So that means you made 6.54% that month. I also bring in the market. I brought in the S&P 500 index, which is a very popular market index. It was only up 4.21%. So you can see that 1 month, the Contra Fund did really, really well. But the Contra Fund is classified as a growth fund. It's buying more growth stocks than value stocks. So I also brought in the large cap growth stock index. It was only up 1%. So when you compare Fidelity to the overall market, the Contra Fund did well, but you compare it to its actual benchmark, which is the growth index, it did extremely well in that 1 month. But then the next month it trailed its benchmark, but it trailed the stock market by less. The next month is even almost more impressive, where it had a 0% return when the markets were down dramatically. You can see that month after month. What we're doing with our attribution is looking at all of these numbers over time and assessing the entire period. So we have a long period of time here, a good 30 years or so, more than that, 35 years of looking at this manager. That may be too long of a period of time. You may want to look at a shorter period, but for our purposes, I'm going all the way back to the very beginning so you can look at how this manager does. Month after month after month of data. You come down to the bottom of all of this data, and we have the summary of it. First, we have 422 months worth of data. That's a lot of data. Basically, you need at least 3 years of data for this to work. So if you can't go back at least 3 years, this is really not going to be good analysis. We look at their average return over time. It is a geometric average rather than an arithmetic average. You can look those up on Google and see what those two mean. But geometric, when you're looking at historical and trying to figure out if the manager did well or not, geometric is really the return you want to look at. You can see the Contra Fund on an annual basis made 13.36%, beating the S&P 500 and the growth stocks by a dramatic amount. But then we look at the standard deviation. That's a measure of risk. How volatile is this manager's returns? And we compare that to the markets. You can see they're in line with the S&P 500, about the same risk at 14.5%, but they're much less volatile than their main benchmark of the large cap growth. Then I'll look at alpha. What alpha means is what was their return versus the market. So here we have 13.36% versus 10.57%. They beat the S&P 500 by 2.79% on an annual basis, and they beat growth stocks by 3.19%. Tracking error essentially asks their returns versus the market, how volatile is that? So it's essentially the standard deviation of their alpha. So if they made 12% versus 10, that's a 2% alpha. How volatile is that alpha? You want tracking error to be low so that you have some predictability. If your tracking error is really high, like 7, 8, 9%, Essentially, you don't know what that manager is doing. You think they're a large cap growth manager, but with a high tracking error, they may only have 10 stocks in their portfolio, and you really have no confidence that they are going to give you the asset class you're seeking. A tracking error of 1, 2, 3% is not uncommon. When you get above 3%, you have a manager that's probably doing something unusual. It might make you a little bit nervous. A very popular statistic is the information ratio, which is pretty basic. You just take the alpha, the 2.79%, divided by the tracking error, and you get the information ratio. Traditionally, an information ratio above 1 means the manager has done really well. What that means is they have a good outperformance relative to the risks they're taking to try to beat the market. That's what tracking error is telling you. How much risk are they taking? Are they going for the fences with a high tracking error? Are they staying somewhat close to the benchmark with the 1 to 2% tracking error? So what we're trying to say here is this outperformance of 2.79% or 3.19%, is that due to luck or skill? And the higher the information ratio, the more likely it is skill, that this manager really has skill. And the contra fund has been a very good mutual fund over time. Another ratio I really like is called a batting average. Very, very simple. It's of those 422 months, what percentage of the time did the contra fund beat the market? And you can ask whether it's the S&P 500 or large cap growth. But here, I think I did it against the S&P 500. Their batting average is 0.57, which is actually quite good. For a manager, obviously you want the batting average to be above 0.5. 0.57 is very, very strong. You're not going to see many 0.6s and 0.7s. It's just very rare for a manager to consistently beat the market on that percentage of a basis. Another ratio I really like is the upside-downside capture. What upside capture says is when the S&P has a positive month, what percentage of the S&P returns is this manager capturing? And when the S&P has a negative return, what percentage of the S&P returns does this manager have? So you can see when markets are up, the contra fund essentially matches the S&P 500, has the same return, close to 100%. But when the markets are down, the Fidelity Contra Fund only gets 83% of returns, and that's what you want. If the market's down 10%, it'd be nice that your fund's only down 8.257%. So on the downside, you want a low percentage. On the upside, you'd like a high percentage, or at least right at 1. And you see this a lot with professional managers. They tend to hold close to markets and up markets and tend to reduce your risk in down markets. And that is a benefit to you because you're probably more worried during down markets than up markets. If your manager's making 10% when the market's up 10%, that's fine. If your manager's losing 8% when the market's down 10%, yeah, that gives you some comfort that at least they avoided some of that downside risk. Another ratio is beta. You may have heard of beta, but beta is essentially saying how much does this fund correlate with the S&P 500? A beta of 1 would mean they exactly move together. They have the same, what we call systematic risk. They're very much exposed to the same type of factors in the overall market. Beta below 1 just means they're probably a little less exposed to economic cycles. You somewhat see that with the upside and downside capture. You would expect, if the upside capture is higher than the downside capture, you would expect a beta below 1, and that's what the contra fund gives you. These are some basic statistics. There are others. You may look up the Sharpe ratio or Trainer or Jensen. There are other ratios out there. They all have their own benefits and downsides. They're all a little bit cumbersome to calculate. As far as which ones are actually predictive, unfortunately, none of them are particularly predictive. Just because a manager has a good information ratio does not mean they will perform well into the future. The only one we found that really has some predictability is batting average, but even then it's not that strong. Most of these ratios are somewhat uncorrelated between historical performance and what you see into the future. Now, could you create this analysis yourself? And it's pretty tough to do, and let me show you why. What I did in column D is I pulled in the data for the Fidelity Contra Fund, but I pulled it in from Yahoo Finance. Column C I pulled in from Bloomberg. We have a Bloomberg machine, and I can bring in the data. What the Bloomberg machine data does is it adjusts these prices for the contra fund for both dividends and capital gain distributions. The contra fund in Yahoo Finance, those returns only adjust for dividends. It does not adjust for capital gain distributions. Here's the Yahoo Finance. Here's the Bloomberg. So D is Yahoo Finance. E is Bloomberg. If I go down to the bottom, a good example is December. In December, the true return for the contra fund was a negative 5.7%. But if you pull the data from Yahoo Finance, it looks like they lost 14.19%. Why? Because in December, most mutual funds distribute their capital gains, usually all in December. And because of that, their stock price or their mutual fund price drops dramatically because they distributed all this money. If you don't make an adjustment to that price to adjust for those capital gain distributions, you're going to grossly understate your return. You see the same thing in the previous year. There's the December number off of Yahoo Finance, and there it is for Bloomberg. You can see a huge difference. And so I use the Bloomberg numbers because Bloomberg has an account that allows you to adjust for capital gains. If you don't have access to a Bloomberg machine, I really don't have anything to offer you. I wish Yahoo Finance would create a statistic for mutual funds where they adjust for the capital gain distributions, because you can see it is quite material. But we just don't have that, and I can't provide you the data. I can give you the spreadsheet, but I cannot provide you the data from Bloomberg because Bloomberg is a contract I have with my school. I cannot offer to people all around the world to pull data from Bloomberg and provide it to them. So you'd have to find a Bloomberg machine, or if you have access to Capital IQ, you could make the adjustment yourself, but it'd be very cumbersome. You'd have to go back historically and just look. The advantage you have is that most of these funds, their distributions are in December, so you would not necessarily have to make an adjustment every single month. You can see most of these months, the Yahoo Finance in column D and Bloomberg column E are almost identical. And then you get to a December, you can see it's quite materially different. So that's it. That's everything you have there, in my opinion, for wealth management. Do you want to do it yourself or hire someone like a Vanguard and just use their target funds? Obviously, there's a lot more to this. If you want to do it yourself, you're talking about a tremendous amount of research. But the bottom line is you can do very good wealth management without spending a lot of money in fees. There really are one-stop places to go that are very inexpensive, that are going to give you an answer almost identical to what the expensive wealth managers will provide, but they'll probably outperform because there are much lower fees, and lower fees gives you an advantage. Hope this has been helpful. Feel free to email me with any questions or to get access to any of the Excel spreadsheets, and good luck with your own personal wealth